Welcome to Subramani. I'm going to talk about the perennial conflict that investors have, wondering whether to put money in real estate or whether to put money in equities. I hope to confuse you enough at the end of the video that I'm not going to give any answer or give any conclusion. But I have most of my money in equities and not so much in real estate. But let us look at real estate. First of all, real estate is definitely less risky, or that is what the government tells you. The government of India allows banks to lend as much as 105%. I mean, 105 is an exaggeration, but 95%, 98% home loan or even a premises loan, commercial premises loan is far easier to get. Whereas if you go for loan against shares, you will have to pay a 50% margin. Now, this is very difficult to believe, but this is what the government of India says how lending should happen. Now, so does the lending institution. They all copy the same thing and they will all happily lend to you. Let's say you're a young professional, maybe you're a doctor, lawyer, chartered accountant, whatever, but you are in business. Let's say you're in business, then the willingness to lend to you is also very high. And they are willing to lend you a big portion, because in India at least even now the lenders believe a portion of the house cost is covered by cash anyway. So to that extent they have a margin. Apart from that, if they take a 5% margin also, that's enough. Now, bankers are here to make money, right? So they would like to lend maximum to you and try to earn money on the interest that they can charge you. So obviously they lend very high amounts of money on real estate. What happens when you take your equity shares and mutual funds and tell the bank that you want loan against that? I don't think any banker in today's market or in any market is willing to lend more than 50% to you. So one asset where they're willing to lend almost 100%, and other asset where they're willing to lend only 50%. It's very clear that the world thinks, the government thinks, and the lenders and the bankers, they all think that it is safer to lend money against real estate than against equity shares, because you cannot run away with your real estate. It is there physically, your personal guarantees are there, right? They can touch and feel. So therefore, for whatever reasons, they are willing to lend you more. The bankers are willing to lend you more. The rates charged on a home loan is far less than the rate that you will pay on a loan against shares, right? Loan against shares, even in this market today, you will pay excess of 12%. But in case of loan against property, you could pay as low as 6.5%, 6.7, 6.8%. Now that's a very, very low rate, unseen over very long periods of time. So this is again proof that the government of India thinks that it is safer to put money in real estate than in equities. Now, what about you? Do you think you can make more money in equities or more money in real estate? Again, a funny question, because you are allowed a much higher leverage. So suppose you buy a house today for 2 crores, and out of that 2 crores you put only about 15-20 lakhs of your own, which itself is high. You can put even lesser, and you get a home loan under 7%, let's 6.6, 6.8%, and what you are looking for is the real estate to appreciate by a number greater than 7, right? Even if it appreciates at 8, 9%, you're obviously going to make a lot of money, because in absolute terms you will make a lot more money in real estate than you can in equities, because in equity not much leverage is available, and even if it is available, the whole society, bank, government, everybody frowns upon people who borrow and invest or trade in equity markets. So in absolute terms, you will always make more money in real estate than in equities, but the challenge is in finding real estate which appreciates by at least 7% over the next 10, 15, 20 years, in which time you hope to repay the loan. Of course, if you repay the loan earlier, it doesn't change things, but yes, it makes sense to repay the loan as early as possible if you have excess cash which you do not wish to invest in equities, etc. As time goes by and equity appreciates, more and more people are pulled towards real estate, and they think they can make more money in real estate. I am not taking sides. I am not even saying you should now sell equity, buy real estate, or sell equity, buy gold. I am not getting into it. I am just saying the whole world, the whole society, the banks, the government, everybody pushes you towards buying real estate by making money cheaper and by giving you tax incentives for repayment. There is no such thing in equities, right? Equities used to be tax free till a couple of years ago. Now long term capital gains tax without indexation is at 10%, which is very, very, very high in a country with high inflation, right? So we will be worried about that 20-30 years later when inflation is, if inflation is high and this 10% doesn't change. So yes, every push is towards you to buy real estate. So you have to take a call whether you want to buy real estate or equity. Now come to the other great asset, that is gold. Gold not long ago was languishing at 30,000 rupees for 10 grams. And then the US-China problem happened and the price slowly inched up maybe to 40. And then COVID happened and the price went up to 52, 53. Now it is down to about 42, 41, 42. So that is 20% down from the peak. And now is the buying that is happening, and now is the relationship manager at full swing selling. So at 50,000, when one friend of mine sold gold and put it into his pension plan, because I thought gold had done very well. So he is very happy that he put that money into his pension plan, but not everybody does things like that. But you have to remember that gold is a good asset, but it will always go up in jumps and starts, like something COVID-2 or some more US-China fight or anything like that happens. Then you will see gold go up. But again, gold will go up, gold will remain like this and then go up like this and then remain like this. It could even come down. There is nothing stopping it from coming down. But the jump in gold always happens during panic. It has to be a war, it has to be the US bombing North Korea or the US bombing Syria, right? Any of those things happen, then you could see gold go up. Otherwise, gold does not go up steadily. Gold does not go up at the rate of inflation. Yes, gold goes up in spurts. So when you're looking at gold returns, for heaven's sake, please don't look at CAGR. Look at discrete returns. Last 2 years are an aberration in the life of gold. It has gone up dramatically. So if you have bought at 50,000 and you're averaging, it may be a wrong asset to average, right? And secondly, the price of gold today is a function of how well oil behaves, how well dollar behaves, how well cryptocurrencies behave, right? Bitcoins. It is a function of all these in the world apart from geopolitical reasons. So anybody who says they can predict the price of gold is just taking you for a walk, because even real estate I will be able to predict, provided you tell me the price, the location, and the potential for earning rent over a long period of time. There is some cash flow to justify the price. You may still take an emotional decision, but at least there is some cash flow. In case of gold, there is no cash flow. It just means somebody else has to believe that the price of gold is better, so therefore I buy. It's not a cash flow determined price. So it's very difficult to say gold should be at what price. Whether gold you should buy at this price, because I know a lot of people who are now doing an SIP in a gold ETF because they thought they missed the ride from 30 to 50. I don't know. I have my own views. I don't have too much of gold also in my portfolio. So this is a good video, largely meant to tell you that inflation, oil prices, everything matters in the price of gold and in the price of real estate. But what to do is a conclusion which you have to arrive at yourself. I've just given you the bare facts. I have not explained anything. These are the bare facts. Understand that inflation, oil prices, US dollar rate, cryptocurrencies, all these determine the price of gold. Many of these factors would also determine the price of real estate. It is also possible that we are at the peak of the equity boom and at the bottom of the real estate boom. Everything is possible. Please collect all the facts, think about it, and then act. Don't expect me to come here and say put money in the multi-asset fund. I don't know, right? So I have some money in some multi-asset fund, but bought for a completely different reason. So you have your facts, your data, take your decision. Thank you.